Hey Surge Hunters! Welcome back to Dividend Surge, the channel where we chase the most explosive opportunities to boost your passive income with US stocks, ETFs, and, of course, dividend heroes. I'm Max, and today's question is one that comes up in the comments all the time. How much can you actually make if you put $10,000 into JEPI right now? We're pulling back the curtain and going straight to the real math, the mechanics of JEPI's monthly payouts, and the ups and downs you won't see on those viral, too good to be true clips. Don't go anywhere, because by the end of this episode, you'll have the tools and facts you need to decide if JEPI deserves a place in your portfolio, or if your cash is better off elsewhere. And don't forget, smash that like button, subscribe if you haven't already, and comment with your favorite monthly dividend ETF. Let's kick off with the basics. What is JEPI? JEPI stands for JP Morgan Equity Premium Income ETF. It's become a sensation in the dividend investing world, and honestly, the entire ETF landscape, because of its unique formula, monthly income, high yield, and S&P 500 exposure all wrapped into one product. Here's how it works. JEPI holds a diversified portfolio of over 100 large-cap US stocks, most of them household names, the kind of companies you see every day in the S&P 500. But JEPI isn't content with just regular stock dividends. The magic happens through covered calls. The fund sells call options on part of its portfolio. The premiums from these options generate extra income, which gets paid out to shareholders, on top of the usual dividends from the stocks themselves. This means investors can potentially earn an even higher yield compared to just owning those blue-chip stocks directly. Now, why has JEPI exploded in popularity, especially in 2024 and 2025? For two reasons. First, the monthly payouts, which make budgeting and retirement planning so much easier. Second, consistently high yields, sometimes in the 7 to 10% range. That's huge for an income ETF with real blue-chip exposure and a big-name manager. Let's pause for a second. Why does monthly income matter so much? Most dividend stocks pay quarterly. That means waiting 3 months for a payout and then managing your spending or reinvesting. Lumpy income. Monthly dividends, like JEPI's, let you align your passive cash flow with your everyday needs, bills, fund money, or reinvestment. It also feels a heck of a lot more tangible. Getting a paycheck from your investments every month is psychologically rewarding. I hear from people all the time who say monthly dividends help them visualize their progress and stay motivated on that wealth-building journey. How much from $10,000? Let's get to the main event. If you put $10,000 into JEPI today, what does that actually look like for your monthly income? Here's the current math. As of July 2025, NAV/share price, roughly $55.70 per share. Check your broker for the precise number. It does fluctuate daily. $10,000 buys you about 179 shares, rounding down for round lots and possible commission slippage. Trailing 12-month dividend yield, 8%. It's varied in the past year from 7.2% to 9.5%, with an average close to 8%. Now, the key, JEPI's monthly dividend payout fluctuates a bit because it's based on both stock dividends and option premiums, which change with market volatility. On average, payout per share/month is 37 cents, last 12 months. That's 179 shares times 37 cents equals $66 per month. Annually, this is $66 times 12 equals $792 per year, not including compounding. How JPI makes that income? Let's lift the hood. How does JEPI actually generate that juicy income? Core holdings. JEPI owns a widely diversified collection of US large-cap stocks, currently over 100, with names like Microsoft, Visa, United Health, Abbott Labs, Coca-Cola, and more. Usually, these are stable, mega-cap companies with solid balance sheets and steady fundamental outlooks. The covered call strategy. Here's the twist. JEPI sells equity-linked notes, ELNs, which are similar in effect to covered calls. This means the fund collects option premiums every month for renting out part of the upside on its stocks. What's the trade-off? In a big bull market, the call selling can cap upside. But most months, those premiums pile up as income, regardless of whether those blue chips go up, down, or sideways. That layer of option income, overlaid on a blue chip core, is how JEPI delivers $60 to $75 a month on your $10,000. JEPI was launched in May 2020, and while it doesn't have as long a track record as the big-name index ETFs, its performance in terms of income and relative stability is solid. Price movement. Generally, JEPI has shown lower volatility than the S&P 500, meaning less wild up and down swings in value. Dividend stability. Despite short-term dips in payout, the 12-month rolling yield remains high, thanks to the resilient covered call overlay. Capital appreciation. Slower than the S&P 500. Over 3 years, JEPI's price return is moderate, but total return, including dividends, is very competitive for income-focused investors. Compared to competitors, SCHD has higher long-term price appreciation, but lower yield, around 3.5%, and pays quarterly. QYLD offers 11 to 12% yield but with questionable price stability. The NAV tends to erode over time because the entire option premium is distributed, even in bad years. JEPI sits in this sweet spot: robust monthly yield, strong risk controls, and minimal capital decay. Curious what you're actually getting exposure to with JEPI? Current sector concentrations, as of July 2025. Healthcare, 18%. Information technology, 15%. Industrials, 13%. Consumer staples, 13%. Financials, 12%. Rest, spread across communication services, energy, and more. Top holdings often include megacaps like United Health Group, Microsoft, Visa, Coca-Cola, Merck. Unlike some more aggressive options ETFs, JEPI avoids excessive concentration in just a handful of tech stocks, helping stabilize payout and share price. How do real investors use JPI? Let's bring in a couple of real-world examples. Case 1. Retiree portfolio. Jane is 67, retired, and wants reliable monthly cash to supplement her Social Security. She invests $30,000 in JEPI, setting up a $200 per month direct deposit for groceries, bills, and the occasional dinner out. She sleeps easier knowing her core is in strong U.S. companies. No gambling on risky single stocks. Case 2. Growth-oriented young investor. Carlos, 32, splits his portfolio, 60% in S&P 500, 20% in SCHD, 20% in JEPI. He reinvests JEPI income every month. Over a decade, Carlos uses JEPI as a cash churner to buy dips in growth stocks, funding investments with actual dividends. No need to sell core holdings. Both Jane and Carlos benefit from JEPI's core strengths but tailor their approach to personal goals. JEPI's dividend schedule and dates. JEPI is famous for reliability. Here's the practical guide. Ex-dividend date is typically the first business day of each month. The record date is a day or two later. Dividends are paid around the 6th to 8th business day of the month. If you want that sweet payout, be sure to purchase before the ex-dividend date. Update for July-August 2025. July ex-dividend, July 1st, pay July 7th. August ex-dividend, August 1st, pay August 7th. Check the JEPI page at JP Morgan Asset Management for official numbers each month. JEPI's main advantages: steady, high-yielding monthly payouts, lower volatility compared to most income-focused funds, blue-chip underlying portfolio, minimizing single-asset risk, flexible use as a standalone fund or income booster in a diversified portfolio, potential risks/drawbacks. Upside is capped. If the market goes on a wild bull run, JEPI won't keep pace, as call premiums limit capital gain. Monthly income can fluctuate, option premiums vary, and dividends can be cut in rougher markets. Covered calls won't protect you in a big bear market. NAVs can still drop sharply alongside stocks. Expense ratio is higher than a vanilla S&P 500 ETF, but pretty competitive versus other high-yield income funds. Not ideal for those seeking maximum capital appreciation or those uncomfortable with options overlays. What could make JEPI more attractive in the future? Persistent market volatility. More options premium equals larger monthly payouts. Higher interest rates benefit option sellers since carrying cash and options becomes more lucrative. What could reduce your yield? Markets that become extremely calm, with low volatility, option premiums decrease. Regulatory shifts that change how covered calls are taxed or operated. A sudden, sharp bear market, which could cut both premiums and capital return. Surge spark. Imagine 2026 brings even more volatility due to a heated election year and inflation surprises. If option premiums spike, JEPI's trailing 12-month yield could surpass 9%, potentially boosting your $10,000 position to $80 to $85 per month. JPI versus the competition. Let's wrap the compare and contrast. JEPI, king of monthly, high yield, low volatility payouts. SCHD, quarterly payouts, better historical capital growth, much lower yield, 3.5%. QYLD, even higher yield, but more NAV erosion, not ideal for long-term growth. Divo, monthly yield between SCHD and JEPI, with dividend growth tilt. SPY/VO, pure S&P 500, low yield, high growth. Use JEPI as your income engine. SCHD for dividend growth, and SPY/VO for wealth compounding. There's no single answer. Here are a few. Dividend Surge Portfolio Templates. All-in income, 100% JEPI, $66 per month per $10,000. Balanced approach, 70% SCHD, $29 per month, 30% JEPI, $20 per month, equals $49 per month, but with more growth and less yield variability. Growth Booster, 60% S&P 500 ETFs, 20% SCHD, 20% JEPI, income plus upside gumbo. Adjust the mix to fit your goals. Remember, some of JEPI's cash payout is return of capital, not qualified dividends. That usually lowers your cost basis, good for now, but can mean higher capital gains tax when you eventually sell. If you're investing through a 401k or IRA, tax isn't an issue, but keep records if it's a normal brokerage account. When in doubt, talk to a CPA. Let's address 3 common questions I get about JEPI. Can JEPI's dividend dry up in a market crash? Short answer: payouts will likely drop, but not disappear, because there's always some premium in options markets, and many underlying stocks keep paying traditional dividends. Is JEPI safe? JEPI is as safe as a well-diversified S&P 500 portfolio with an options overlay. It's not FDIC insured safe, but in the world of high yield, it's among the most stable. Will JEPI outperform in a bull market? No. The call selling will cap total returns during big up years. If you want moonshot growth, pair it with growth ETFs. If your goal is consistent, hands-off monthly cash flow, JEPI is a powerhouse. If you want both yield and capital appreciation, balance JEPI with SCHD or an S&P 500 ETF. Remember, high yield can mean higher risks. Diversification is your life raft in all seas. To recap, in July 2025, a $10,000 investment in JEPI could put around $66 per month in your pocket. Reinvest those dividends, and watch your income snowball with compounding over time. Let me know in the comments, are you investing in JEPI? How does it fit in your strategy? And what high-yield ETF should we break down next? Please hit that like button, subscribe so you catch the next dividend wave, and share this video to help more investors build unstoppable passive income. I'm Max, and this was Dividend Surge. Let's keep riding those waves of income together. See you in the next one. Disclaimer: this content is for educational purposes only. I'm not a financial advisor. Always do your own research and consult a pro for personalized guidance.